In this video, traders, we're going to look at how can you make money trading an index or anything that only moves 1%. Is it worth it? Stay tuned. Hey guys, a warm welcome to Alright, so this was part of a question from a viewer or subscriber, Justin Cracker. Appreciate your comment, sir. Thank you very much. And something that he mentioned was, okay, so you've got an index, and let's say it moves 3% in a day, which is an extreme move for an index, but he's using hypothetical figures here. And let's say you're lucky enough to capture 1% of that. What's the point in this? You're capturing just 1% of the move. Is there any point in doing it? There's no even point in something he said was, unless you're using above, say, £50,000, because 1% of 50,000 is £500. It's not really worth it, right? Over time and thinking. So his thinking is, well, if something's moving 1%, what am I missing here that makes this worthwhile? Okay, Justin, great question, and something I want to address in this quick video now, because I think it's often overlooked by many traders, especially people coming new into the business or whatever, like, well, how does this whole thing work? So let's have a look at it. And hopefully I've got the gist of your question correctly. If not, it's going to be educational anyway. If so, good stuff. Right, so let's imagine now, let's use that example of an index. You've got the FTSE sitting there. It's quoted at 7,488, 7,490. That could be any instrument out there, any index, any oil, any commodity, etc. And we want to buy it at £10 a point, okay? And that's a spread betting approach with £10 a point. It could be 10 CFDs if you were CFD trading. It could be contracts, and it's slightly different, but it could be some value of a quantity of that offering that you're buying, whether it is a CFD, a spread bet, a futures contract, anything like that. Even an ETF, for example, you're buying a number of shares, but then the order of magnitude would be different. But let's use this for example. But the important thing here is this number here. So if we're buying £10 a point or 10 CFDs or whatever, the notional value of the position we're buying is the quantity multiplied by the actual value of the underlying that we buy it at. So in this case, the FTSE, if we're buying a futures contract, it's the same, except one futures contract has a fixed notional value depending on which contract you're trading, so it just varies based on the price, and you alter the number of futures contract, but you have a notional value. In other words, it's the underlying value of that asset of your position, generally speaking. So in this example, we've got £10 a point times by 7,490 gives us a notional value of the position of £74,900. That's what we're in control of effectively when we're trading this. Now, a broker is going to let us trade this on margin. So in other words, they're going to say, okay, the notional value of that position is £74,900. We don't need £74,900 from you. We're happy for you to put up what's called a margin percentage. And in this case, for this example, all brokers are different. We want you to put up just 5% of the notional value, because from a commercial perspective, they know the FTSE is not going to go to zero overnight, or very, very unlikely. They know that the range is reasonable compared to, say, some crazy stock where they require more margin. So they have a commercial decision on how much margin they require. They also know they've got a lot of people long, a lot of people short. So as a company, they're reasonably hedged if they're a spread betting broker. So they say, okay, so you can put up just £3,745 worth of margin. In other words, you must have more than that in your account, and you've got to have a little bit more into allow for movements and stuff. And there's a little bit more of intricacies into that. I've done a video on that exclusively, but the point is you only have to put up a small chunk of the notional value to control that position. Okay, so let's look at scenarios now as what might happen. So scenario one, the FTSE goes in your favor. You've gone long, you've bought this at 74,090, which is the offer price. Notional value of 74,900 goes in your favor. Now the FTSE a few days later is quoted at 7610 to 7612. You want to sell your position, so you've got to sell it on the bid. £10 a point times the bid price is 76,100. Don't forget, that's your notional value of the position. So what you've made is the difference between the price you bought it at, which was 74,900, and the price you sold it at, 76,100. £1,200 pounds, which is the difference, or if you just take 74.90 from 76.10, you got 120 points, and that's why we do £10 a point. So you've made 1,200 or 1,200 pounds from that, and you've only really theoretically had to put up margin of 3,745. So what's that, about 30% ish of return on your money for that one trade? So let's look at another side of it. We'll go back to that in a second. The other side is you lose money. So the FTSE now goes down in value. You're wrong. You've bought it at 74,900. You sell it £10 a point at 7,400. The notional value for that is 74,000. So you've lost £900 on that trade, which is about what is that? About 25%, something like that. So you've lost 25% of your margin that you put up for that. Now, going back to that percentage terms, I'm a little bit, some people use percentages in different things. So some people might say, well, I've got, 100 grand account, I'm trading £10 a point. Should the percentage be on the account size? Should it be on the margin allocated? Should it be on this? Should it be on that? Listen, that's why I think percentages are a bit of a funny way of doing things with trading, because capital's a tool. Because one, different now, slightly different with ESMA coming in, but one broker might offer you 1% margin. Does that automatically mean that you're a better trader because you're making more money on the trade? Not really, because there's lots of other things to go into consideration there. And what about if you've got 100 grand in your account and you're risking that? Does that mean that you're making X percent, whatever that percentage is on those on your 100 grand? Is that the real money? But then what happens if you only put 50 in for security, you got 50 in another account, or 50 backup? It's very difficult, I think, to use percentages, and I think that capital should be considered as a tool rather than a percentage, because let's be honest, guys, as traders, we can put up some pretty impressive numbers for percentage returns as well, as opposed to the investors. Now, this is a good point to mention that investors may be saying, okay, well, to control this amount of money, let's say they've got 75,000 in their investment account, they would buy 75,000 pounds worth of a product with that full money. And if it moved up to 76,010, they would make 1,200. But that would be the small percentage based on the allocated capital they've put in there. So that's the difference. Even though the move is the same, the difference is that as a trader, we don't have to put up that full amount. We're using the amount that really is not needed to something else for something else. You can see why that's a double-edged sword though, of course, because losing 25% of your money each trade could knock you out pretty quickly. You can see why it's quite powerful as well. Losing that leverage means that you could gain a decent amount very quickly and multiply your account very quickly. But hopefully you can see that if you've got a leveraged account, you're losing that leverage and you're using the margin, that's when the gains start to get tweaked right up, because you're actually compounding the effect of a small movement. And that's the point in trading with any instrument, guys. We're compounding the effect of a small movement with the allocation of capital using that margin that brokers offer. All right, guys, thanks for your question. Appreciate anyone who's got any comments. Please stick them in the comment section below, and I'll see you next one. Take care. Bye-bye.